Ladies and gentlemen, we've now reached a very interesting part of these proceedings because this is where we begin our first set of awards for this evening. This is a highly anticipated part of the evening, as I said. We will be talking about Beyond Valuations, Rethinking Startup Success Metrics, which, as I said, will be followed by the much anticipated TiE Lumis Entrepreneurial Excellence Awards. This session is powered by Lumis Partners. For the next proceedings, I would now like to call our next set of guests on stage. Nitin Nayar, co-founder and managing partner, Filter Capital. Saurabh Chatterjee, director, Chrys Capital. David Wilton, Chief Investment Officer, Oister Global, and Sandeep Sinha, who will be the chair for this session, Managing Partner, Lumis Partners. Could we have the distinguished guests on stage, please? And could we have a huge round of applause?
Thank you, everyone. Just a quick correction. In our conversation, we realized Raghav was making more interesting points than Saurabh, so we decided to replace him at the last minute. So that was a fairly exciting session talking about AI and the future of humanity. I think this conversation is going to be more around the entrepreneurs and the entrepreneurship. We have seasoned investors on the panel here. And the idea today is to be able to dissect what makes these investors cut a check. What translates into capital raise for the whole lot of investors sitting over here to the entrepreneurs sitting on the other side of the room. So let me start with the first question with you, Nitin. There is always this conversation which is floating between valuation and value creation, right? And I think all of us understand at the heart, the value that you create will hopefully translate into valuation, but not always the case. In your mind, when you start talking about value creation, what does it mean and what does it refer to?
Thank you, Sandeep. And look, great to be a part of this panel. And it's going to be really difficult for us to follow up the last panel. And our messages are going to be a little bit more sobering. But at the same time, we hope that it provides some context and value to aspiring entrepreneurs and current entrepreneurs.
And as long as you cut the checks, I think everybody will be happy.
That's right. You know, I think that when I think of creating value, I would probably frame it in a single sentence, and maybe every word in the sentence has its own meaning. It's the aspiration of developing a product or service in a way different from others that your customers value at a price they are willing to pay, which allows you to recover your cost of development and cost of delivery and cost of acquiring those customers. And what remains is value. And as for companies that are very large and are at the cusp of profitability, which is what many of us on this panel evaluate, we can look at things like cash flow, ROCE, contribution margin, retention. For entrepreneurs who are at very, very early stages in their journey, maybe they raised a seed round or a series, or approaching a Series A, or maybe they're bootstrapped and they're looking for their first check. I think investors are going to pay very, very close attention to some of those ideas around value creation. What is the product or service you are offering? Is there a demand for it? Are you doing it in a way that others are not doing it? Or how are you going to charge for it? Will what people are willing to pay cover the cost of development, delivery, and customer acquisition? If any of is the market even large enough? If any of those questions are not answerable, then I think investors will struggle. But to the extent that you're able to line that up, even in the earliest stages of your journey, then you are then able to articulate a path to value creation, which I think will make even seed and Series A and early stage investors take note.
Thanks, Nitin. Very, very insightful. Udai, you've been investing at Affirma for a long time. In the last few years, have you seen a shift in terms of how investors evaluate the companies in terms of their ability to create values? I mean, has the basic metrics changed? Has your way of evaluation shifted over the last, I would say, at least 3 to 4 years?
Yeah, no, thanks for having me. Look, I think the fundamentals have remained pretty much the same, right? Where if you look at the early stage of businesses, the idea is to develop a product or service and get to some level of scale. So we are in the mid stage. We do mid stage private equity. So we're looking at companies which have some history, ideally are profitable or getting profitable. But one of the things I'll say is that even I'm trying to make it relevant for an early stage entrepreneur here, right? Who has to raise money. So obviously people look at unit economics, contribution margins, and so on, right? But I'll give you two metrics that I think a lot of entrepreneurs, even at the mid stage of capital, we find ignore or don't give adequate importance to. And both those are on the balance sheet side of the equation. One is cash conversion, right? Which is your working capital cycle. And second is your return on capital. So a lot of people are worried about EBITDA margins and top line growth, and that's obviously important, right? But I'll give you an example. Yesterday I met an early stage entrepreneur who's building a pharmacy chain in Rajasthan and Uttar Pradesh. Obviously he's not profitable at a corporate level. He can't be, he's too small. But his store level ROC is 200%. His average order value in a small town in Rajasthan is 60% higher than the average order value somebody is selling in Nepansi Road in Mumbai. Because the requirement for the customer in a second-tier city is availability of medicine. It is not about 10-minute delivery. It is not even so much about price. It is about availability. So if you can build a business where your AQ, average order value is 60% higher, your capex is much lower, obviously you can have a 200% return on capital. And that's a fabulous business. Now the question is, how do you scale it, right? So what's his strategy to scale it? He says, I will only do UP and Rajasthan for the next 5-10 years. And if I master that, that's good enough for me. I mean, that's what DMart did, right? So a long-winded way of answering your question. So I would say cash conversion, return on capital at a very micro level, at a store level, it doesn't have to be at the corporate level, is something people overlook. And I would encourage people to think a little bit more about that.
Well, thanks so much. Raghav, you're part of Chrys. I think perhaps a firm which has been investing for about 25 years in India, more than $6 billion worth of exits given across the companies and so on. I mean, you have seen a whole spectrum shift over a period of time. For a lot of entrepreneurs who are sitting over here, if you were to give your head share, right, your mind share to say, these are 3 or 4 things that they should target as a North Star where their business is headed, what would those be?
No, thanks. Thanks for having me. I think obviously the immediate things which pop out, right, of my mind are, what's the addressable market, right? Because India is a large growing opportunity across both product as well as services. So what's the addressable market that you are chasing? And what's the cost of servicing it, right? Because market is large across a variety of industries. Even when we evaluate businesses, for example, there is a big trend of unorganized, right, losing share, while organized, right, industries across a swath of industries are gaining share and prominence. So I think the question is, there needs to be a large enough market to go after, and what's the cost of then servicing, right? Because the market may be very attractive, but if it has got serious entry barriers, then that starts becoming challenging. Also, I strongly agree with what Udai was mentioning around the balance sheet metrics, because I think capital efficiency is a motto we've had practically over the last 15, 20 years, right? And whether you evaluate a business early on or even, right, 10 years out or 15 years out in its lifespan, I think how much capital was needed to potentially build that business gives you a sense of the greatness of the business, if you have to which is why something in the consumer space, FMCG space typically has got that longevity. You've created a business with not a large amount of capital, while some other industries may need large amount of capital. So that's something that any entrepreneur, right, or somebody who's looking to build over a 10-year sort of, or 10 years or even beyond, should be looking at. The other thing I would say is, eventually you need to look ahead, right? Early on, obviously the goal is to scale. But scale at any cost is not right? Maybe that was a sort of a good or a prevalent method. I won't say good, a prevalent method a few years ago. But today, as people look to raise subsequent capital, I think unit economics question is very much front and center. So that is something that I would at least right think it should be considered early on in a company's evolution and an entrepreneur's thought process.
Thanks, Raghav. David, you are a part of Oister Global. You invest across top-tier funds. One of the big shifts that has happened is that the cost of capital has gone up in the last few years. So money which was relatively easily available is probably not so. Do you think that shift is going to change the way investors look at investing in, whether it's an early stage, growth stage, matured stage businesses? What's the shift you expect?
Yeah, the cost of capital creates a very large shift in investors' mindset. So post-financial crisis, when major central banks, Central Bank of China, Fed, European Central Bank flooded the market with liquidity, and then again in response to COVID, the cost of capital basically in large parts of the world went to nothing. And when the cost of capital is nothing, people get incredibly optimistic and start to look at compounding values out 20 years. They get very long-term views. I'm exaggerating, but the time horizon goes out. Now that phase is over. Interest rates are up and they're likely to stay up. I can't see any reason why they're likely to go down in the rest of the world. So that whole mindset of being willing to fund things long-term and take a very long-term view, that mental horizon is shortened considerably. And really what that means, I think, for a startup entrepreneur in India is that on the one hand, you're sitting in what is probably the only bright spot on the globe. So that's a nice positive thing. On the other hand, the bulk of the money in the private part of the market in India comes from people who are sitting in less friendly environments. So SoftBank, Tiger Global, their world has changed. And they're the guys who you're hoping to sell to at the sort of the final stages of growth. They're not going to pay up so much. So you've got to ask yourself, as I'm building this, thinking ahead, who is going to be the buyer, what do they need, and what are they going to be prepared to pay? And probably at the moment, you'd need to look at the Indian public markets as an exit route much more seriously than you would in the past, and think to yourself, what is it that market wants? Now, obviously, if you're an early stage company, you can't achieve the sorts of financial metrics that a mature stage company has. But you need to be thinking of building in that direction, because probably your exit route in the next 5 years or so is more likely, the attractive exit route is more likely to be the Indian public markets than waiting for a Tiger Global or a SoftBank to come back again.
Great, thanks. We were outside during the lunchtime, and I think there were lots of questions around entrepreneurs looking at different business models. And I think there are like so many different ways of cutting the business. There were questions around B2B, B2C, D2C, product versus services, domestic versus global businesses, and so on and on. So I think just want to get a sense from the panel over here that you guys have been evaluating businesses for more than a decade, right? When you look at any of these businesses, how do you visualize this? So maybe Udai, if you want to take a shot versus, there is a question about B2B versus B2C. And the prime question in everybody's mind is B2C is explosive growth, but it's also explosive cash burn, right? B2B is a little bit more controlled growth with more deterministic cost structures. So when you look at the difference in these kind of models, I know you don't have like a black and white preferences, but do you have a directional view between the two?
Yeah, so firstly, I'll say there's all kinds of investors, right? There'll be some investors who like B2C more and B2B more or B2B2C more. I'll talk about ourselves. We have a strong preference for B2B or B2B2C. And here's the reason why. We find when you're investing in B2B businesses, they tend to be cash flow positive much faster. Some of the financial metrics we talked about, they tend to achieve it much earlier. The multiples that you can, the valuation entry multiples that you can get those businesses at are relatively much lower than a B2C business. They burn less cash. They take shorter time to build. So those are the positives, right? The negatives are that the value creation, I mean, having a 10x in a B2B business is not that easy. Having a 10x in a B2C business is easier, but you got to be more patient. You got to be patient for the first 5 years or 10 years. But I mean, I'll give you a quick example. We've got a company called TBO that we invested in, which is a B2B2C business. It's in the travel tech business. Now, you could go for a B2C business. Your cost of customer acquisition is going to be so high, you're going to burn money for the first 10 years. Now, do you have the patience to do that? And some investors like that model. When we bought TBO, the investor who sold is Naspers. Naspers took a strategic view at that time. I don't want to do B2B. I want to do only B2C. So they were in IBIBO and Make My Trip. While we said we like B2B, so we will be in TBO, which is a B2B2C business. But anyway, we have a strong preference for B2B.
Nitin, you have done some B2C setups in different parts. What's your take?
No, yeah, I mean, I have looked at and invested in, while at my current firm, Filter Capital, and at my prior firm, Warburg Pincus, we looked at both B2B and B2C businesses, and we like them both. I would say that if there were aspects of B2C businesses, if I were to line up and say, okay, what would make me really interested in a B2C business? And I'm going to differentiate between omni-channel retailers and direct-to-consumer brands. Let's talk about tech-only B2C businesses. It's always helpful to have a very diversified supplier base and a diversified buyer base. So all of these B2C businesses are essentially two-sided marketplaces. The more fragmented you have on those marketplaces, on both the supply side and the buy side, the more interesting the position the B2C player can have in the long run. So if you were to think about an OTA, you know, a hotel OTA is always a little bit more interesting than an airline OTA because there are only so many airlines, but there are lots and lots of hotels. The other dynamic that I think is interesting would be categories where there are no clear winners just yet, because it's going to be very hard to be a number 3 player behind Zomato and Swiggy. So if you're an entrepreneur building a B2C business, focus on categories that are still emerging. Now, you know the TAM, the addressable market, a lot of investors worry about addressable market. The addressable market in those categories may be small today. If you take a 10-year view, you know what direction this country is going. A 10-year view, the addressable market may actually be quite large, and you'll be the number 1 player because you identified it first. So try to find those white spaces where there are few incumbents and build along those lines. The third is go for viral, referral-driven growth. You want your first set of customers to be people who use your product and service, and they love it, and they tell their friends about it, and you don't spend $1 in marketing trying to acquire them. And that thing can build exponentially off a small base, but it grows very, very quickly. And that also distinguishes number 1 players from number 2 players, is just the virality of the growth. And last, I would think about, be careful about segments where the cost of delivering the service is high. So you can look at businesses where they say, oh, my contribution margin is 6%, versus businesses where you say my contribution margin is 60%. And find categories and spaces where the cost of delivery isn't very high, because that has been a little bit of a black hole for many companies. They've burned a ton of money because they said, I can take a minus 5% contribution margin and turn it into a 10% contribution margin. That's really hard to do. There are enough opportunities to turn a 20% contribution margin into a 60, 70% contribution margin. And so there is a playbook for B2C. One has to be careful. But there are investors who are really who are big fans of it. So if you find those spaces and find some of those characteristics, I think there's always an opportunity to build an interesting B2C business.
Very interesting. Raghav, you've seen businesses both on the product and services side, and some of the large transactions you have done are actually on the services side as well. How do you visualize the two kind of business models, or do you have one way or the other that you look at the two kind of business models very differently?
No, I think historically services companies has been India's forte, and a lot of companies have scaled out, right? Going back to the Infosys and the HCLs and everything else. We believe, and obviously we've ridden that wave and been fortunate enough to back a few, right, in the last 15, 20 years. I think the product time frame, we believe the environment for product companies has improved significantly, and clearly there is a big sort of opportunity that Indian companies finally are acting, right, as the ecosystem has matured. And one example I'll give you is, I think on the product companies, the big thing is you need to do a little bit more of R&D and product development early on, which potentially will mean some capital, right, and potential equity dilution in the first 5 years versus a services business, which is generally very cash flow supportive. So that's where if you are okay taking, right, and there's a venture and investor ecosystem which has come along. So even at Chrys Capital, we've taken a bet in a software as service, SaaS company, right, just 6 months ago, believing that in the next 5 years, lots of companies have come through. Clearly, there is a little bit more of experimentation, right, in a SaaS company versus a typical services business, which is more cookie cutter. So therefore, that's the one thing that needs to be balanced. But we believe product companies clearly have the opportunity, right, to emerge out as formidable companies out of India.
Great, thanks. David, you have recently announced investments in OIPF, the fund which has a blend of 5 different kind of funds underneath, including Chrys Cap and Filter. So when you look at these funds, is there a defining characteristic that you were talking about, like liquidity and so on and on, that you see us valuing far more today than ever before?
Yeah, no, I think certainly the market now is focused not so much on scale and just growth for its own sake, but much more on achieving metrics and cash flow positivity. In fact, talking to different GPs and not just the ones that we've included in OIPF, there really is a push in the early stages to get companies to focus on how they can get to positive unit economics, how they can get to positive cash flow, rather than just sheer growth. Because, excuse me, the ability to burn cash and have investors be willing to accept your burning cash for year after year after year, that sort of disappeared with higher interest rates. So that characteristic is there. Obviously, the other one is just your ability to grow and get scale on some sort of positive basis. And there, I think, obviously the Indian market is large, but if you can get a business that can grow in India but then expand overseas, that gives you that extra scale, which is attractive.
Great, thanks. So that basically sums up, a few different perspectives with which the investors on the dais here today are talking about investing. How about we take some questions with respect to, if there are anything. We have a question right in the front, please. If you can quickly share your name and a short question and to who it addressed to.
Hello, I'm Ravi Agrawal. Leading social impact investor, India Network is quitting from India investments. So is there only profit is only metrics, or social impact can also be for investment metrics? And second question is that all the investors are like only unicorns, or they do also like the Zebra startups also, where the profit also matters? And my third question is specifically, Mr. Udai, as you are investing in the B2B segment specifically, as they are able to generate the profits. So what's your take on debt funding versus equity funding? Because generally they need a capital as a working capital to get their things roll on.
So we'll just take one question for now. So last one, Udai, if you want to talk about debt versus equity funding.
Yeah, I mean, look, if your cash flow is supported, there's no harm in taking debt. As a general rule, we are conservative. We prefer companies which are modestly leveraged. And the reason for that is when you are in your early stages of building the company, there could be all kinds of tsunamis that might come, right? There might be a demonetization, there could be a COVID, credit crisis, etc. And so you need to have the ability to take the hit. And if you're too leveraged, then you may not be able to weather the storm unless you have equity support. But it's a fine balance. A little bit of debt is fine.
We'll take one more question.
Hello, my name is Piyush. I'm an aspiring entrepreneur. I want to ask from the set of investors, like, look from your point of view, what are the emerging themes coming and from the investment point of view, apart from AI and the typical software stuff? Thank
You
you.
want to take that, Nitin?
You know, it's interesting. We've got a panel of private equity investors, and we like to see the data, and we'd like the entrepreneur to tell us what the emerging trends are. I think you've heard from us that we're big fans of software and services companies, and we believe that the product opportunity and the services opportunity will continue to be a massive opportunity for the next decade or so. There's a dearth of consumer brands, in this country, and you're seeing so many direct-to-consumer businesses emerging. I mean, and entire funds, including one that, of course, Oister is backed, that is only focused on consumer brands, and that we think is a huge runway. I think everywhere you look, there's going to be opportunity. One of the big themes that Filter Capital is interested in is this idea that technology entrepreneurs will be able to create businesses in traditional industries using technology to displace both the unorganized market, but also organized incumbents. So pick your industry. There's a ton of opportunity. The question is, where are you most passionate? Where do you have the expertise? Where do you have the ideas around, okay, this is where I can do something in a differentiated manner to build a product or service that I know customers will love, that they're going to pay me for, and what I receive in revenues is going to be greater than what I have to pay in costs. Leverage that, and maybe if it means you have to spend a few more years in industry to build that track record, to have that insight, to then before you go out on your own, that would be worth doing as well. Or maybe choose the industry that you want to build a career in, that you want to build a business in. If you like beauty, go work at Nykaa. If you like FMCG, go work at ITC or Unilever. And then eventually say, aha, here's the opportunity, and I've got years of experience. And then investors will say, hey, we'll write you a check.
And you'll see the background, right? This panel is an extension of the TiE Lumis Awards, which we have been doing for 16 years. And across these 16 years, almost every year we see about 100 plus companies coming from all the various sectors, different cuts, business models, commercial models, and so on and on. Interestingly enough, these awards recognize the companies within the first 3 to 4 years of their existence. And you'd be pleased to know that, the cumulative value created by just the awardees of this program crosses about $15 billion. I mean, we have had companies like, Moglix, Make My Trip, WebEngage, Capillary, Nolarity, a whole bunch of companies which are market leaders in their own right. So this year, again, we had about 100 plus entries. And out of those 100 plus entries, I think we shortlisted down to the last 4. And we're just going to play a very short video to give everybody a quick view of which those 4 companies are. And then right at the end of it, we are going to announce the winner for today. So can we have the video, guys, please?
Thank you very much for having me at the launch of DigiBox, which is India's indigenous and fully homegrown digital asset management provider. DigiBox offers digital file storage and organization by providing an easy, secure way to store data.
A testament of Make in India initiative will become synonymous with data storage, security, and safety in the near future. And I urge all to make DigiBox an inherent part of your business ecosystem.
It's very important how fast you can retrieve your data. We are going to give our enterprise customers an extremely easy to use backup solution for their endpoints.
Actually, economical also and eco-friendly also.
It is quite affordable, and as far as the service is concerned, it is like really good.
It was like an invention of wheel for me. One solved everything, and this was so helpful and so easy for me.
You are the only agency in Odisha, those who are doing it.
And I need a bike. And we were like about to buy this electric vehicle, and then I got to know about Drivey and the options the people have told me. I found this one more better than buying an electric bike.
They have given the best services all over Bhubaneswar.
Today, when India is being globally talked about for its achievements, we still have a few issues to address for rural India and its healthcare. 70% population of India lives in villages, but only 20% of healthcare infrastructure and manpower is in villages. Thus, they live 5 years lesser than their urban counterparts. Meadow Plus, with its rural-focused health tech app, works in association with Meadow Mitra, the village-based entrepreneurs. Meadow Mitra is a trained associate who interacts with and visits rural households, assists patients, maps symptoms and ailments to the specialists, books appointments, manages health records, and makes payments digitally. Well-trained Meadow Mitra connects villagers to facilities at the click of a button.
Our commercial pilot in more than 400 villages has been extremely successful, and that gives us the confidence that Meadow Plus can organize healthcare for rural India across the country in the coming days.
In less than Meadow Plus now ensures easier, timely, and appropriate healthcare for rural India. Meadow Plus. Click, connect, care.
So if everybody can give a big round of applause for the top 4 companies. And thanks, everyone. So these companies were selected from the top 100 entities that were submitted. And to thank the jury who basically did this shortlisting from 100 to 4, I would like to call upon stage Anil Gupta, Managing Partner, India 3 Lines VC. Smita Mishra, Founder, Fandoro. Vinod Sood, Managing Director, Hughes Sestique Corporation. And Vishal Gandhi, Founder and CEO, Biorex Venture Advisors. Thank you. Thank you. Thank you. And with that, we are ready to announce the winner for the evening. And the final award goes to Digibox Technologies.
conducting the proceedings. Congratulations to all the winners. Can we just have a huge round of applause for all the winners? We'd also like to thank our associate partner, Department of Science and Technology.